You know, I want to talk to you about stock price valuation. Right there, we got a problem. You know, what does the word valuation means? How much that stock is worth? The valuation on the stock, well, what are you talking about? The market price? No. How much that company's true value is worth on a per-share basis is not necessarily the market price of the stock. If I tell you a stock is trading at $113 a share, 67 and a quarter, 57 and 5/8, it doesn't mean the stock is worth $113 a share, or 57 and a quarter, or 13 and 5/8. Well then, what does the word worth mean? And how does that relate to the stock's price? The price of a security trading in the market is simply a price that people are willing to buy and sell when they trade that security. It's just basically, to give you another analogy to the real estate market, I sold my house for $980. It doesn't mean it's worth $980 with me so far.
Yeah.
Kind of think sale price versus the assessed value of how much the home is worth. To put that kind of in perspective for you with that analogy. And so, what do we use to determine the value on a stock, to determine how much it's really worth? I mean, is $113 a share overvalued for that company? Undervalued? Should we be buying it, selling it, and selling it short? Well, I don't know. It's trading at $113 a share. But we do know. We do know if $113 a share, or $185 a share, or $250 a share, or $9 a share is overvalued or undervalued relative to the company's earnings. And the word earnings means profits. When you take a look at the correlation between the profits of a company relative to its stock's price, expressed in the form of the ratio known as the price-earnings ratio, which looks at, don't write, look, but looks at the stock price trading out there in the market, 138 and 5/8, 16 and a quarter, and you compare the stock's price to the profit picture of that company. That ratio, based upon the interpretation of the price-earning ratio, will let you know if at 113 and a quarter is 67 and 5/8, the stock is overvalued or undervalued. So when he sees that stock, and he sees Qualcomm trading at $67 a share, or he sees Yahoo at that price level, he doesn't know what the stock price represents relative to the earnings of the company. He's not sitting there looking at the interpretation of the price-earnings ratio to determine the valuation on the stock. He sees 67 and 5/8, 113 a share, and should we pick up a position at this particular level? You're telling him we're picking up a position at this particular level because the price-earnings ratio on the stock, based upon fundamental research and strategies, say that that stock is grossly oversold and undervalued. The stock price should be trading much higher than what's trading in the marketplace because the earnings are strong enough to be able to support a higher valuation. You see why you need this understanding of the valuation on the stock? To be able to determine if the price level it's trading at is overvalued or undervalued relative to its earnings. You then intertwine the research technically, you'll be able to see what is oversold and undervalued at a support level. The price is trading below support according to technical research, which means it's a strong target buy recommendation at this price level according to the charting and the graphing of stock pricing. In addition to that, the price-earnings multiple and the earnings ratio on the stock suggests that $67 a share is grossly undervalued. The earnings can support a higher valuation, and that's why I want you to pick up 10,000 shares right here at this particular level to show you through trading profits the potential rising momentum, because the stock price is bound to come up because she's cracking through support, and the earnings suggest she should be trading in the $70 range. Mr. Johnson, you might never see a price at this level again for a while in the stock. Oh, really? He doesn't know this interpretation. Are you with me so far?
Yes.
So with the sophisticated accredited client, you're never going to be able to get out of the recommendation, let alone present the idea, unless you have a basis of that recommendation, because he understands a little bit about the earnings multiple and the valuation of the stock. Certainly if he's got 1.5 million, 750 in the market, dividend distributions and how they're taxed, he might not know, but certainly on the valuation on a stock, he went to school a little bit. Are you with me so far?
Yes.
So you have to know more for him to gain that confidence to commit the capital to you. Are you with me so far?
Yes.
If he thinks he knows more than you, or you don't think that you're educated enough truly, acutely, as to why he should be buying that particular investment, he's not going to commit the capital to you, nor should he. Are you with me so far?
Yes.
You have no business making the recommendation. So therefore, we talk about where that stock price should be trading at, what is the true value of where that stock should be trading at, completely independent of its market price. Are you with me so far?
Yes.
The truth. The ultimate truth as where the stock price should be trading at. And today I'm going to give you the ultimate truth, the true value of a stock on where it should be trading at, where exactly its price, independent of its market price, exactly at the price I'm about to qualify for you today, it is exactly at true value. where neither to the nano penny is it overvalued or undervalued, and that is an education you're just not going to get anywhere else. I also want to talk to you about the profitability or the earnings of a company. You know, we said so many times that earnings, profits, gains, losses, cost basis, sale price, everything is expressed on a per share basis on Wall Street on a quantification basis. Am I right?
Yes.
The profitability of a company is expressed or its earnings per share as well. So if a company reports earnings of $1 a share, they didn't earn $1. It's per share to common. Are you with me so far?
Yes.
Which means what? Which means that for the quarter, because earnings are reported over a 4-quarter year, you with me so far?
Yes.
If a company has 10 million shares outstanding in the market, and they report that they've earned a profit of $1 per share for 1 share of common, well, then that's multiplied times the number of shares they have outstanding. This company's profit for the quarter was $10 million. Am I right?
Yes.
If you estimate that profit to be continued over a 4-quarter year, they could be a $40 million profitable company. Am I right?
Yes.
So when you look at earnings reported at 67 cents, are you with me so far?
Yes.
Per share times the number of shares outstanding, that will determine the dollar profit for the quarter over a 4-quarter year. Earnings, which are profits, are expressed on a per share basis. Earnings per share, first, primary. The first reported level of profitability on the company for the quarter for 1 share of common. Profitability, earnings are reported per share. Are you with me so far?
Yes.
And then the formula to find the profitability or the earnings of a company for 1 share of common expressed on a per share basis takes the net income, which is another way of saying the net earnings of the company, which is its bottom line profit. Are you with me so far?
Yes.
Because we're talking about the profitability or the earnings per share of common, we want to subtract and remove out preferred dividend money from the company, which would in the numerator give us reduced net income or reduced net earnings. Are you with me so far?
Yes.
And then of course if we divide that by the float, which is the number of shares of common outstanding, we get earnings per share, the profitability expressed for 1 share of common stock. Are you with me so far?
Yes.
I'm going to do this formula again for you. In order to understand the profitability of the earnings for 1 share of common, are you with me so far?
Yes.
You have to take a look at the dollar profit of the company, which is his net income, its bottom line number. Remove out the preferred dividends, gives you right here consolidated net income or earnings. Divide the earnings by the number of shares of common outstanding, you get earnings per share. Pretty easy, am I right?
Yes.
Am I right?
Yes.
It's not tough, am I right?
Yes.
Earnings per share fully diluted. There's that word again. Reduced profitability for 1 share of common. Reduced earnings per share, reduced. Why would the earnings be diluted or reduced for 1 share of common? There must have been a strategy that was implemented in the market that caused an increase of the number of common shares outstanding, not only diluting the stock's price, but diluting the profitability of the earnings per share of common. And that strategy was conversion. Are you with me so far?
Yes.
When convertible securities are converted into common, we have dilution to the stock's price, and we also have a dilution or the reduction of the earnings on a per share basis, supporting a higher float, that income. Are you with me so far?
Yes.
And then, of course, there's, as I started out, with the price-earnings ratio of the company, which is probably one of the most important, and the correlation between where that stock price is trading at in the market relative to the profits of the company. And based upon, the more important point, your interpretation of the PE ratio. We can get any ratio. What's the ratio saying? We'll let you know if the stock price is overvalued in level or undervalued in level relative to the company's earnings, to be able to then issue the buy or the sell recommendation tied to fundamental research. That's why these 3 ratios are the most important, because that, along with the key technical research, will give you the opportunity to establish a presentation of an idea that you wonderfully call a stock pitch. Get the word pitch out of your vocabulary now. It is a presentation of an idea, whether it's Qualcomm or Dreyfus Mutual Funds or intermediate government bonds. That presentation of that stock recommendation has an opening point. Are you with me so far? In the presentation of that idea to the clients, with the key points in the body of its key fundamentals and technicals that suggest oversold, undervalued, tied to fundamental and technical research, where the almighty close would say, so let's pick up now 25,000 shares of a $13 stock. Will that be in a cash or a margin account, Mr. Johnson? You know now why. This is the level we need to accumulate a position at. Are you with me so far?
Yes.
It is a presentation of an idea. When you get licensed, I will write presentations for you so you can eliminate this pitch mentality of this myopic view of becoming a stock jockey and have more of a macro approach towards the recommendations of the portfolios that you trade. Are you with me so far?
Yes.
It's about education, folks. Right?
Yeah.
Isn't it really? Isn't it really, though? Don't you think? Sure it is. Anyway, so let's talk about a company. That was just the interpretation of those formulas. Well, I have a new company I want to share with you. I have for you right here. Can we take a look at this company? Why not? Grass, you want to participate? Okay, well, come on up and get it. Only because waiter service is a little slow today. We had to lay off some people because of the economic landscape. You with me?
Yes.
Want to talk about this document? Got it in front of you? Need another one? There it is. Let's take a look at the information this company has. Let's take a look at their financial picture right now. This company is the XYZ Corporation. Are you with me so far?
Yes.
They have earnings before interest and taxes, which we'll talk about what that means, $800,000. The company has issued, look at the paper, $1 million worth of convertible bonds at 9% yield at a conversion price of 20. Wow. Means something right there. Just showing you how to read it. We'll find out what it means in a moment. The company has raised $100,000 of preferred stock money. They've offered the preferred out there at 7% yield, which is the cash dividend payable on the par value. The par value is $100,000. The company's paying out $7,000 in cash dividend distributions to preferred stockholders. Isn't it wonderful when you can read the financial language? Are you with me?
Yes.
The company's at the 34% corporate tax rate, and right now there's 150,000 shares of common outstanding in the float. Wow. With that criteria, can we find this company's earnings per share primary, earnings per share fully diluted, the price-earnings ratio on the stock, and interpret the valuation of whether we should be trading it and buying it and selling it or selling it short? Look at me. Sure we can. Piece of cake. Now look at me. Right now, there are 150,000 shares outstanding in the market for this company. Is that agreed?
Yes.
Folks, we're crunching some numbers. I just need some response from you. Yes?
Yes.
Okay. What are the preferred dividends? $7,000. I just read it to you. Agreed. We can't find the earnings per share because we don't know the net income of the company. Now, how do you find out the net income or the net loss of any company in the end if they're profitable or they're not? Are you with me so far?
Yes.
The end bottom line numbers. Net income, the word net is gross minus all expenses. Are you with me so far?
Yes.
Here's how you find out annually, quarterly, if a company is profitable or not. Are you with me so far?
Yes.
The first you look at is the gross revenue that comes into this company from the sale of their product or their service. Are you with me so far?
Yes.
Look at me here. I don't care what business that company is in. They're going to be selling a product or a service, and they're going to be generating revenue and gross sales and gross revenue. The first expense every business has to pay is to maintain itself. Am I right?
Yes.
So gross revenue minus operating and maintenance costs to run that business equals 7 EBITDA. EBITDA. Can you say EBITDA? Say EBITDA. Oh, the financial language is like a Stradivarius, you know. What is EBITDA? Look at me. Earnings, which means profits, before this company, look up, has paid out any bond interest expenses. If they have a bond interest expense, they would only have a bond interest expense if they issued bonds to raise capital in their capitalization. Am I right?
Yes.
And before they paid their taxes. So, gross revenue minus O&M equal EBITDA. From EBITDA, earnings, profits before interest and taxes. Look at me. Then they would pay bond interest expense to bondholders if they have a bond interest expense. Then they would pay corporate taxes. Are you with me so far? And guess what? If this company has money left over, they have a profit. A net, in the end, bottom line, net profit. If they have a loss, the financial accounting reporting for losses, parent, number close parent. Are you with me so far?
Yes.
So this is how you determine if they're profitable or they're non-profitable. Are you with me so far?
Yes.
We don't have to take the gross revenue minus the O&M because they're already starting us out with the top of that document. I just gave you EBITDA of how much? $800,000. Look at me. What's the bond interest expense? $90,000. Where did I get that from? They offered $1 million par value worth of bonds, paying 9% bond interest to bondholders. 9% on $1 million worth of bonds is a $90,000 bond interest expense. And what else? The company was at the 34% corporate tax rate, am I right? Yes. After all is said and done, look at me. This company has a net income of $468,006, am I right? Yes. Plug it in, look up, watch close. It's going to happen faster than you know. This company's net profit, dollar profit, in the end for the year was $468,600. Minus the preferred dividend distribution money, get it out of there because we're talking about the profitability expressed for one share of common, am I right? Yes. Gives you what? $461,600. dollar profit. Divide that by the number of shares of common outstanding of 150, you get profit per share for one share of common, which is a very hefty $3.08 per share. Primary first level of profitability reported for the company on a per share basis for one share of common. Good. Dilute the earnings. Done. Convert the bonds. How do you convert any convertible security? You take the dollar par value of how much the original security was worth, and the dollar par value of these convertible bonds are worth $1 million. Are you with me so far? You divide that by what? The conversion price. What is this formula? The conversion ratio. $1 million worth of convertible bonds converted at a conversion price of 20 will give you now 52,000 shares of common after conversion. Am I right? How many shares were there prior to conversion? 150. How many shares are going to be after conversion? 200. That 150 plus 50. Thank you. It's the same formula. Am I right? Same formula. But because of the increase of the number of shares of common outstanding as a result of conversion, that's going to dilute the earnings. Am I right? Yes. Same formula. Get out the preferred dividends, remove them out. But not only is the float changed from 150 to 250 as a result of conversion, something happens to net income. The bonds no longer exist. Where did they go? They were converted into 52,000 shares of common after conversion. Am I right? Yes. So this company no longer has a $90,000 bond interest expense. Am I right? Yes. Simply put, net income goes up by $90,000. They don't have to pay that $90,000 out because it was converted into 52,000 shares of common. So therefore, if the original net income was $468.6 plus 90 now, because they're not paying bondholders, it's $528. With the increased level of profitability of the company as a result of the fact that the bonds were converted into common, removing out the preferred dividend distributions, supporting a higher float, that's going to reduce the profits of the company to $2.61, fully diluted and reduced earnings per share to common. Are you with me so far? Yes. I'm going to make up a stock's price right now. I'm going to tell you that this company, this stock right now, it's trading in the market at $35 a share. And I'm going to look at the $35 a share and I compare it to the company's profits of $3.08 per share. Per share. Everything is correlated on a per share basis. And this ratio is asking the question, is that stock trading at $35 a share overvalued in price at 35? Undervalued in price at 35? Are the earnings strong enough to be able to support a $35 valuation? Should we be buying that stock at 35? Should it be trading higher? Are the earnings strong enough to be able to support this stock trading in the 40 range? Or are the earnings weak and cannot support a $35 level? Maybe the stock should be trading in the 20s. What is 35? It is the stock's price. What is the true value where that stock price should really be trading where exactly to the nano penny? It is neither undervalued or overvalued, but exactly trading at exactly true value. And that is the ultimate truth, and that's what I'm going to give you today. And so, $35 a share divided by a level of earnings of $3.08 per share gives us a price-earnings ratio of 11.36 to 1. And I said we can have any ratio, but if we don't know what the ratio means, it's not going to tell us anything about the valuation on the stock relative to its market price, which is what the price-earnings ratios formula is designed to accomplish. Are you with me so far? Yes. So, I want to give you some interpretation for PE ratios so you can understand what 11.36 to 1 means. Are you with me so far? Yes. In order to understand what the PE ratio means, you need to understand benchmark price-earnings ratios. Now I need you to stay focused. Are you with me? Yes. This is based upon today's research and today's values with today's analysts, and I want to talk to you about old economy stocks. Companies have been around 50, 75, 100 years. Yeah, like whom? Like Mickey. I love that mouse. I've been to Disney World more than 20 times. 11 before I had children. We'll talk about why next week. No, the week after. I'm very passionate about that Dow 30 component. Great American concept. As American as McDonald's and Coca-Cola. We'll talk all about it. And a Dow 30 component, by the way. I'm talking about the Disneys, the IBMs of the world. Companies that have been around, Pfizer, for many, many years. Are you with me so far? What do we know? Are you with me so far? Yes. What do we know about these companies? They're pretty consistent. They're pretty stable. Are you with me so far? They usually pay a cash dividend to the common stock investor, which means because cash dividends to common is not guaranteed, they're consistently profitable. Are you with me? Yes. There are blue chips. Are you with me so far? And they don't trade with a lot of volatility unless they experience systematic risk. Are you with me so far? Yes. They have significant outstanding shares and not necessarily just our large cap companies represented by the S&P 500. And so therefore we expect from these stable companies of 50 and 75 years in age and history that they have a strong profit picture, and therefore as a result of the expectation of strong earnings, are you with me so far, they are assigned a benchmark PE of 50 to 1. We'll see what that means in a moment. This is the benchmark PE for stable, profitable companies. What about new economy stocks, like Qualcomm, like all of the technology issues in the Ciscos of the world, with the exclusions of Intel and Microsoft, because they are Dow 30 components. Are you with me so far? They are treated like an old economy issue. Are you with me? I say that with that prerequisite. What do we know about new economy stocks? Well, they don't have the profit picture and the stability and the consistent earnings that old economy companies do, am I right? Yes. Nor should they be expected to. So therefore, they are assigned a higher PE benchmark. The higher the PE benchmark, the lower level of expected earnings. Are you with me so far? Yes. The lower the PE benchmark, the higher level of expected earnings when the PE reflects the strength in earnings and the relationships of the stock's price. Are you with me so far? Yes. So companies with a PE, an actual PE, the actual PE is the PE that's actually reported, which is showing you the relationship between the stock's price and the earnings of the company. That actual PE is then compared to the benchmark for that industry in that sector to determine if it's overvalued or undervalued at $35 a share. You with me so far? Yes. When you take the actual PE that's reported and compare it to the benchmark, you'll be able to determine the valuation to the following research. And I promised you I would bring in research for you, and I never lie. I only lie to my family. I don't lie to you. Are you with me so far? Yes. I call them little white lies just to keep them happy. Are you with me? Yes. Real fundamental research. Went to Bloomberg for you. But I keep research. I'm a hoarder because I want to date back and look at certain historical evidence. And so I want to talk to you about some companies, and I want to show you their actual PEs. And I want to compare it to their benchmark at their price levels to determine if the price-earnings ratio is letting us know if the company is overvalued or undervalued relative to the earnings. And then I'll give you the ultimate truth of where a stock price should be trading at in the marketplace, where to the nanopenny it is neither overvalued or undervalued, but trading at exactly true value, which is the ultimate in knowledge. Are you with me so far? Yeah. I want to start out by talking about Qualcomm. You know that company, right? We've been talking about it in the past. It is a technological issue. It is a new economy stock. And when Qualcomm was trading at the time at $59.45 a share, I'm talking about a $60 stock. Are you with me? Yes. Qualcomm's trading out there at 60. Client looks at Qualcomm and he says, what do you think at 60? Well, Mr. Johnson, here's what I think about Qualcomm at $60 a share. You see, when Qualcomm was trading at $60 a share, the actual PE that was reported when the stock was at 60 for Qualcomm was 41.87 to 1. Mr. Johnson, Qualcomm's benchmark is 100 to 1. So any actual PE that's under the benchmark means the stock price is undervalued. If the actual PE was over the benchmark, the stock price at 60 a share would be overvalued. 41.87 to 1 is well under 100 to 1. The stock at $60 a share should be trading much higher. The earnings are suggesting with the PE actually reported under its benchmark that $60 a share is grossly undervalued. The earnings could support a much higher valuation. I want you to pick up 100,000 shares in the stock, and that's why. Are you with me so far? Yes. How about Dell, new economy stock? When Dell was trading at $35.39 a share, $35 stock, the actual PE reported to Dell by Dell was 35.04 to 1. Look at its benchmark, 100 to 1. So what do you know about Dell at $35 a share? You should be buying 200,000 shares of the stock across the board. She's grossly oversold and highly undervalued. What about Toys R Us? $12 a share stock. Are you with me so far? Yes. Toys R Us benchmark is 50 to 1. The actual PE when the stock was at $12 a share was 12.03 to 1. Grossly undervalued. Are you with me so far? Yes. How about Cisco, new economy stock? When Cisco was trading at $26.82 a share, what do you believe about $26 a share at Cisco? The actual PE of Cisco was 43.26 to 1. Not grossly but significantly under its benchmark of 100 to 1 when the stock was at 26, a strong buy recommendation. The earnings suggest that stock price should be trading much higher because the actual PE is significantly below its benchmark. How about Walt Disney? Yeah, you knew I was going to give you that one, right? When Disney was trading at $24.91 a share, what's Disney's benchmark? 50 to 1. The actual PE was 38.92 to 1 when the stock was trading at 24, almost 40 to 1, not grossly under its benchmark. So the stock is a good $27, $28 stock. Could support that, the earnings. Not grossly undervalued, but undervalued no less at $24 a share. Microsoft, benchmark. I'm asking you for the benchmark. 50 to 1. It's a Dow 30 component. Well, Microsoft was trading at $27 a share. You with me so far?
Yes.
Right? Pretty great buy, right? The PE on Microsoft was 27.68 to 1 when the stock was at 27. Well under its benchmark to 50 to 1. You understand why it's trading at where it's trading at right now, and a significant buy recommendation at that level. We look at Intel. Intel at $33 a share. New economy stock, benchmark?
50 to 1.
100 to 1. Intel? No, you were right. 50 to 1. It's a Dow 30 stock. Are you with me so far? And therefore, 46.54 to 1 when the stock was at $33 a share, close to its true value. Are you with me so far?
Yes.
We'll get to the truth. Coca-Cola, $50 stock. There it is, $50.04 a share. You with me so far?
Yes.
It's never going to be 138. It's never going to be 13. Coca-Cola's 50. At $50 a share, the benchmark is 50 to 1. The PE by Coke was 26.75 to 1 when the stock was at 50. Are you with me so far? It's almost half its benchmark. Stock should be trading much higher than that. The earnings are strong enough to support it, be a much higher valuation. Are you with me so far?
Yes.
Another buy recommendation at 50 a share. And so we look at these companies. How about Pfizer? 50 to 1. When Pfizer was trading at $35.40 a share, the actual PE was 20.82 to 1, well under its benchmark of 50 to 1 when the stock was at 35 a share. Again, another strong buy recommendation. eBay. eBay. Benchmark?
No.
Not no. What is the benchmark? No. Okay, yes. What is the, I want the friggin' answer. What do you mean? 100 to 1. No. When eBay was at $64.81 a share, the actual PE on eBay was 94.63 to 1. Now, 94.63 to 1 is very close to its benchmark when the stock was at $64 a share. So that's close to its true value. It's a $65 stock. It's not an $80 stock. Are you with me so far?
Yes.
I think you're starting to get to where I'm going with this. And if you're not, I'm going to tell you right now. I want to talk to you about Yahoo. Do you Yahoo? Yes or no? I Yahoo. Do you Yahoo? What's Yahoo's benchmark?
New Era.
Yes, so can I have the benchmark, sir? That's what I want you to tell me. Now, when Yahoo, watch this carefully now, was trading at $49.16 a share, almost a $50 stock, the actual PE reported on Yahoo when the stock was at $49 a share was 144.59 to 1. What is $59 a share telling you? What is 144.59 to 1 telling you? The stock is grossly overvalued at 59 a share. If I didn't own it, I would have short that stock right there at that particular level. And so we take a look at the research and the data and the interpretation, and it's giving you an indication as to the true valuation of the stock's price relative to its earnings. When we look at what the stock is worth, we compare it to its earnings. Are you with me so far?
Yes.
Which, again, the point I couldn't impress upon you enough is completely independent of the stock's price. Are you with me so far?
Yes.
And so now we have to ask the final question for today, and this is the final point. Well, at what price will determine the exact true value that that stock should be trading at? Where to the nanopenny it is neither overvalued and undervalued. And the answer is, and this is the ultimate truth, it's like the Purple Rose of Cairo. You know what the Purple Rose of Cairo is? If you don't, let me tell you. If you've seen the movie Alibaba and the 40 Thieves, they go through 7 continents of fire and flame and war to get the Purple Rose in Cairo. If you find the Purple Rose of Cairo, you find eternal youth. Are you with me so far?
Yes.
I'm going to give you true love right now, the truth. The truth is, the Purple Rose of Cairo is that when the stock at its price, I'll make up a price, 103 a share, 67 a share. When that stock price trading in the market's actual PE is actually equivalent to the benchmark, it is exactly a true value. And that is the Purple Rose of Cairo, the ultimate truth. And what do I mean by that? I mean by that the following. Now, if I give you a stock like IBM and I say 94 7/8, at 94 7/8, if the actual PE reported by IBM, when the stock is at 94 7/8, it's 50 to 1. If the actual PE is equivalent to the benchmark PE, 94 7/8 is exactly equal to the 100% true value where that stock price should be trading at. When the actual PE on the stock is equivalent to its benchmark, that's the true price of the stock. Are you with me so far? Where if I give you a technological stock, it's trading at $285 a share. You with me so far? You might think it's inflated. But if I told you at 285, the PE on the stock was 100 to 1, and the actual PE is equivalent to the benchmark, 285 is exactly a true value. The true value of a stock's price, where to the nanopenny is not overvalued or undervalued, is when the actual PE is equivalent to the benchmark. When that happens in the market, she's trading exactly a true value. A language you know you need and an education for week 2. Give yourself a round of applause. Your lesson for tonight, tomorrow, and Saturday is as follows. Tonight, I think we need reading of chapter 21 to firm ourselves up on taxation and tax law rules and regulations. No question. Followed by step 2, the notes, and along with their perspective for the 7. I then want you to take Monday's notes, and I want you to review them tonight, because the prerequisite to week 2 is week 1. Are you with me so far? So I want to bring back that language again, principal versus agency and everything that we discussed in the over-the-counter market and secondary market trading, because I need you to have that kind of fresh. Are you with me so far? Yes. So again, after the review of 21 tonight and our notes, I think we need to review Monday's notes tonight. Tomorrow, I want you to crack open the body of the work into chapter 20. And I want you to look at a very short chapter that's not representative to NASDAQ, that chapter, because NASDAQ is much more powerful than what you're going to read. Tax shelters and limited partnerships. And do the best you can about reading about oil and gas and real estate programs and the language and the relationship between limited partners and general partners, and starting opening up that entire arena and that language of chapter 20 and tax shelters. We'll find out why they're all called tax shelters when we get into their regulations on Monday. On Monday night, I want you to review the notes from Wednesday. On Saturday night, review the notes from Wednesday. So what are we doing Saturday? We're reading chapter 20, and we're reviewing the notes from Monday. Now, what are we doing on Sunday? Well, Sunday we're going to read chapter 13.
Saturday, we're reading notes from Wednesday.
Saturday, we're reading notes from Wednesday. Right. Now, what are we doing on Sunday? Sunday, we're reading chapter 13. And, of course, a quick review of the notes from today. And enjoy the rest of your day. The weather's going to be great. But then it's Sunday night. What time? I don't know, about 7:30, 8 o'clock. Not too late, it's not too early. And I think that we then pull out and reread chapter 20 again, so that you come on in with it on Monday, kind of fresh, because that's where we're going to start. You got 3 hours of tax shelters in chapter 20 and 2 hours of margin trading. I'm going after 1/5 of NASDAQ, and when Friday rolls around in 1 week from today of next week, I'm going to complete 50% of the license. I think you understand percentage-wise what next week represents. It's showtime. It's the playoffs now. I'm not talking about red herrings anymore and how to convert securities or the difference between common and preferred. You need to take the entire focus from this week and bear it into each one of those days next week. I mean, 1/5 of NASDAQ just on one day alone, I think you'll see the impact. I don't want you to get lost here. I want you to become competitive. I want you to trade with me. Don't worry about right or wrong answers. But the way you become competitive in here and stay focused and get these strategies to become well-read with many problems. If you need personally and you feel compelled to read a chapter 2 or 3 times instead of once, do it. Do whatever you need to do to get as well read as you can with many problems so we can trade. Don't worry, I teach in English. But I'm telling you now, everything that we've done from week 1 is now born into week 2. The program will take a turn on you on Monday. It's going to start to teach you in this professional language from now on. Are you with me so far? That does not mean I won't go back and forth from English to basic language and strategy language to isolate what's significant for NASDAQ. but we need to understand week 1 in order to get into week 2. Are you with me so far? That's why I'm asking you to revisit those notes. I promise you one of the most exciting weeks you're ever going to see. I've been waiting since I met you to get to the 21st, and I can't wait to get there. Now be safe, stay focused, and I'll see you on Monday. Give yourself a round of applause. Go! Thank you. Thank you. Who's coming with me around the corner for a quick walk? Yeah, let's take a walk. Thanks, Brian. You're the man.
See you on Monday. Monday?
Monday.
Yeah, yeah.
I was thinking of this. You know, I've got this on my mind. Saturday night with Brian's got it.